Producer prices fell 0.1% in August, while expectations were that inflation would increase. We're still awaiting, of course, Thursday's CPI data to see how consumer prices fared in the month, but a positive signal to investors who are anticipating the Fed will cut rates next week. Ed Yardeni, Yardeni Research President, joining me now to talk more through all of this. Ed, it's great to see you. So, does this wholesale inflation number sort of confirm what we're going to get from the Fed, or do we need to still get the data tomorrow?
I think we still need to wait for the CPI tomorrow, but all signs suggest that we'll get a quarter-point cut. I don't see a 50 basis point cut, but it might be discussed at the meeting.
And when you look at the PPI numbers that we got today, how do you square it with the tariffs that have been coming through? How do you think we still manage to see an inflation drop in the month?
Well, we actually have seen some impact of the tariffs on inflation. We've seen it in the durable goods inflation rates, particularly for the CPI and the PCED, the deflator that keys off of the PPI and the CPI. So there's certainly evidence that durable goods inflation has been boosted. Meanwhile, services inflation is slowly moderating in some areas, like the rent component, but other areas it's kind of stubbornly stuck. All in all, I think we can still say that inflation is closer to 3% than it is to 2%, even with today's surprisingly negative PPI.
But you think that the Fed can raise, even given that fact, even given the fact that it's closer to 3 than 2?
Yeah, well, I mean, my preference is that they don't, but they're not going to listen to me. It's pretty clear that Jerome Powell at Jackson Hole changed his tune from hawkish to dovish. He went from saying we're in no rush to lower interest rates to basically saying, well, we should possibly consider making a move. And obviously, they've been talking about lowering rates. Meanwhile, the administration's put a lot of pressure on the Fed. We've got at least 2 dissenters on the Fed, and I think we won't have any dissenters at the next meeting. I think they will vote for 25 basis points and maybe put in some hawkish language that, they're still data dependent, and it's not at all obvious that they're going to keep lowering rates, but they'll watch the data.
Well, and speaking of the data, we've been talking about inflation, but obviously we have to bring jobs into the equation as well. How concerned are you about the job, not just the numbers that we got in terms of last month, but of course the benchmark revisions as well, which showed a big decrease? Right. I mean, what does that say about the health of the economy?
Well, the labor market's been awfully funky. Obviously, it's been distorted big time by the illegal immigration flows that we had for the past few years, and now it's kind of the reverse of that. Suddenly, illegal immigration has stopped, and deportations have increased. I would say that the data, to me, suggests that we actually have more of a supply problem on the labor side. And even when we had a lot of immigrants coming in, there's a real shortage of skilled workers, and that's where the issues are. And then, of course, there's a lot of technologies now that are helping to displace workers. So I think when you put it all together, we have an economy with still a relatively tight labor market, particularly for skilled workers. The unemployment rate for people over 24 years old remains below 4%. The real problem is for teenagers. Their unemployment rate is 13, 14%. And then for college graduates or people 20 to 24, many of them are finding it very hard to find a job. So I think that what's really happening here is that productivity is making a big comeback, because real GDP has been actually coming in at a fairly solid pace. And I don't see that getting revised downwards. If that's the case, then the downward revision in the employment numbers suggests that we're going to have upward revisions in productivity, and that's a good thing for everybody.
And is it also a good thing for the stock market? I mean, I know you've been a bull for a while here, Ed, and you recently put out a note where you talked about the growth that we've seen in earnings, kind of despite all expectations to the contrary here. So that productivity picture, that would also seem to be potentially good for margins and continue to be good for earnings.
Yeah, that's absolutely correct. I think the earnings data really do belie all these fear mongerings that are going on about the economy being much weaker than we're thinking. Earnings suggest quite the opposite, that the economy is doing just fine, and that productivity is maintaining profit margins, which is really surprising. And so it looks as though companies are absorbing some of these tariff increases. Either the importers are in the United States or the exporters are overseas. And the fact of the matter is that earnings are turning out to be better than expected. I've been among the bulls, and even I'm amazed by the strength of earnings. I thought that the market would, by the end of the year, be discounting $300 a share, which is a very aggressive number. And now I think the market may actually be discounting something higher than that. $300 a share by the end of the year, if that's what the market starts to anticipate for next year, multiply that by 22, which is where the multiple is right now, and you get 6,600, which is basically where we are right now. I mean, I think we're going higher, probably 6,800, and that would be with a earnings number that turns out to be higher in terms of expectations.
And Ed, why have earnings been so strong, and why have they defied expectations here? Is it all about AI and this? I mean, you look at Oracle today, is it all about that powering things higher?
Well, I think that's part of it. I track earnings for the S&P 500. I look at forward earnings, what analysts' expectations are, and the analysts obviously are keyed in to the company management very closely. And at the same time, I look at S&P 493. I call them the impressive 493. You know, it's not all about the Magnificent Seven and the IT sector that's dominated by them. Other companies are doing well. Look, these IT companies are coming up with tools that enhance productivity, and that's something that can be used by every company. And apparently that's exactly what's happening. So the earnings surprises to the upside aren't just the Magnificent Seven. On the other hand, one has to be realistic here and analyze the market as it is. And what we're seeing is that information technology and communication services account for 40% of the market cap of the S&P 500 and something like 28% of the earnings share. So they are dominating for sure. But all in all, the earnings picture looks pretty bright. And I see the earnings picture actually broadening out to the upside. And that would explain why the market should very well broaden out.